From our recap last week, the picture is beginning to emerge. Whilst you probably always thought Fred was the wealthiest, otherwise there wouldn't be little point in the comparison, it was really hard to see how. But let's have a look at how their disposable incomes are handled. You'll recall that Fred's disposable income was $58,925. Let's have a look at the after-tax expenses now. Car lease, $0. House loan, $0. Property expenses, $7,000 per year. Car expenses, $3,000 per year. Clothes, $2,200 per year. Entertainment, $12,400 a year. This gives Fred a total expenses of $23,900, which means he's saving $34,325 per year. Let's have a look at John's disposable income, which is $223,740. After-tax expenses are car lease. The part of his car lease he couldn't use because of the luxury car tax costs him $67,080 per year. His house loan costs him $106,667 per year. Property expenses, $10,000 a year. Car expenses, $7,000 a year. Clothes, $5,000 a year, and that includes the coloured tuxes. Entertainment, $62,400 per year. This gives John total expenses of $258,075 per year, which is exactly $34,334 more than he earns. Welcome back to the reverse interview on debt. We're joined by Damien McVeigh. Damien, thank you for joining us.
Thank you very much, Kerry. How are you doing today?
I'm always well, Damien. Thank you very much. What's the most impelling question that you see from the previous two sections?
Well, the first question that came to my mind is I kept tossing around this LVR mnemonic, and I just, thought, what on earth is that?
Everyone talks about them, don't they?
Yeah.
Okay, it stands for loan to value ratio. So if the property is worth 100,000 and you borrow 80,000, then that's an LVR of 80%.
Okay.
Okay. Banks put great stead by LVRs because it tends to limit the amount they'll lend. So typically 80% is a nice LVR. So in terms of normal houses, 500,000 you can borrow 400,000, which means you need 100,000 of your own funds, plus expenses of course.
Mm-hmm.
The reason I use that is because, the reason people like 80 is because, and I'm going to bring in another term, I'm sorry, which we haven't covered, and I'll be sneaky, you don't have to pay for LMI. So LMI is mortgage loan insurance, like actually loan mortgage insurance, but more commonly mortgage loan insurance. And what that means is the banks limit their liability. So if you go over 80% LVR, the bank insures your debt. So if you default, the bank can claim, and they'll still come after you for the money. It doesn't protect you in any way, it only protects the bank. And that LMI insurance is paid for by you. So if you go to an 85% loan to value ratio, LVR, then the expense of the loan is greater because you pay for the insurance. So a good place to borrow at is 80%.
Okay, so I've actually got to take out insurance for the bank.
Absolutely.
I'm not actually taking out insurance for myself.
No. So what happens is, if that insurance is paid out on, the mortgage lender, the person who sold the insurance to the bank, come chasing you.
Okay.
So there's no way out, unfortunately. If you borrow money, you have to pay it back.
Right.
Okay. So that's loan to value ratio. It's quite an important measure in terms of loan.
Mm-hmm. And the other question I had out of the episode that I've seen so far is, you mentioned structuring a loan for particular people. How do you know if you've got into a loan and it's not the right sort of loan for yourself?
Somebody who's buying a house for the first time, to my mind, has a high LVR and there's no flexibility. You can't do anything, you can't borrow against it. There's no point in paying for flexibility when you don't have any. Okay, come back one. So with a high LVR, you don't have any flexibility at all, you just have to pay it back. So with a high loan to value ratio, I think the simplest debt you can buy is the easiest. So the basic loan, no frills, no additions, just really the cheapest loan you can find. Then when you've got the LVR, loan to value ratio, down to maybe 70%, if you're in charge of your affairs, now what I mean by that is, if you have a credit card and you pay it off every month, then the more flexible loans, like line of credit loans, might be appropriate for you. The reason they might be appropriate is that you bank out of a line of credit loan. Right? So what that means is all your wages get thrown in there, that reduces your debt, and you bank out of that loan.
And that's the sort of flexibility you were talking about, if someone's got a low LVR.
Yes, that's right.
Okay.
So with a lower LVR of 70, there's some room to do something else.
Mm-hmm.
Okay. Now, line of credit loans used in this way, banking out the loans, are also very, very dangerous. My proviso was that you have to be able to pay off your credit card every month. If you misuse one of those loans, you can actually spend your house.
Right.
So you can go down the supermarket and spend your house, or go down the grog shop, or even the betting shop, or the tab, and you can spend your house. So they're quite dangerous unless you've got control. But they do have flexibility, and their features do allow for an earlier payment of the loan.
Okay.
Finally, if you've got the LVR down to say 60-ish, and these are all just arbitrary figures, but 60-ish, then you've got 40% equity in your home. Now, as a financial advisor, having 40% of, I don't know, a $500,000 property sitting there paying you no interest is bad. So again, if people understand and are comfortable with borrowing against their home to invest, then that's maybe a good thing to consider. So when the debt's under control, when the LVR comes down, it gives you more options. So high LVR, simple loan, lower LVR, more complex loan, if you have the ability to handle it.
But that could be awkward for people who are at that level of 40% equity in their own home if they take out an investment loan for, even 20%, and then the global financial crisis hits. How does that happen?
Okay, we're digressing a little bit. It's still a good question. The wisdom in relation to shares is this. If you buy a share for $20 and it drops to $10, if it's a good share, it'll come back to $20. It might take a while,
Right.
but it'll get there. Borrowing against your house is a no-no for some people, but it's far better than using a margin loan where the security for the loan is the share you borrow, or
Okay.
the share you buy. Again, we're off target a little, but I'll stay here. With a loan against the house, no one is going to come and say your security isn't enough to support the loan, because the house, of course, is secure. But with a share, if you borrowed 70% on a $20 share and it went down to $10, your security has dropped and the bank wants more money. So that's a margin loan, and that needs, to my mind, it's very appropriate for the right people, but it's just needs a little bit more thought.
So as long as you can hang in there, you should be right.
Yeah, we're probably 2 years ahead of where we need to be talking about equity gearing and margin gearing, but certainly there are things that we will be talking about in the future.
All right. And in talking about loans, I've always thought bank loans, but is there any other sort of loan that people should be looking at? When we talk about loans that are, suitable for certain people.
I think that we've sort of talked through in this chat the fact that loans need to match individuals. It's just like any other financial product.
Mm-hmm.
So if you walk into a bank, or anywhere for that matter, and somebody says, this is the loan for you, it's the wrong loan. It mightn't be, but there's a fair chance it is. What they're actually saying is, this is the loan I want you to buy. If you walk in somewhere and they say, tell me about yourself, what do you do? They need to know how much income you earn. What are your ambitions for this loan? What do you anticipate your payment history to be? Do you think you'll pay it down in 30 years, or do you think you'll be paying it down earlier? Where do you want to go with it? Do you want to buy investment properties? Do you want to gear against it? Do you want to use the equity in your home? If they're not asking these type of questions, then there's a fair chance the loan won't match you.
Okay.
So buy the loan any way you like, as long as you're convinced that they're offering you a loan that matches your circumstance. Thank you very much, Damien. That was superb. Some really good questions.
You're welcome, Kerry. Anytime.
Cool. So thank you very much. That's the end of the show. Thank you for joining us, and we'll see you next week. don't forget our competition. Please go to the website and sign up for our 100 Goal Challenge. Prizes are being generously awarded by AIA Australia, who are giving a free risk assessment away every week and 2 iPads to be won throughout the series. And also Keith Abraham, who's donated his book about finding your passion. Go to the website wealthplan.tv. Thank you for joining us on Wealth Plan TV. I hope you enjoyed the show. Next week we'll be dealing with accumulation.